Hey traders, welcome back. So we're talking today about 5 reasons not to trade Forex. What? Well, if you check out my other video, I talk about 5 reasons that you should trade Forex. Now, there are 5 reasons, at least 5 reasons, these are my main 5, why you shouldn't trade Forex. So it's not as clear cut, you need to decide what's suitable for you, but these are just some things that currency markets aren't that good at. Number 1 is and by the way, this is my opinion on them. Some people might find these reasons to trade Forex as opposed to not being reasons, but hey, you've got to take them on face value for what they are. Number 1 is gaps, or lack of gaps. Okay, what do I mean by that? So currencies trading 24/5 from Sunday night all the way through to Friday evening. No gaps, constantly trading all the time. There's no stopping, there's no closing, there's no opening of it. Yes, they have an open and close print in terms of how they mark to market for the interbanks, but there won't be a close like there is with the stock exchange, won't be an open. Now, that can be an advantage, which is why we talked about some of the reasons you should trade currencies. Obviously, for trading overnight, that's an advantage to you, if that's when you can get involved in the market. But for those of us who like to trade gaps in terms of a specific strategy that works on gaps, for currency market might not be the right one for you, because if you don't have gaps, you obviously can't trade your gap trading strategy that you have. So you need to be aware that if you have a strategy, or if you're building a strategy based around gaps, currency market's not for you. You're only going to get that gap once a week from the close from Friday evening to the Sunday evening open, and that's the only opportunity. So probably not worth using a gap trading strategy unless you have something specific that works well in the currency market during that time. So that's one reason why you shouldn't trade currencies. And I quite like gaps, coming from somebody who trades indices and someone who trades stocks as well, and currencies. Gaps play a reasonable part in my trading strategy, so I wouldn't obviously use currencies to look for gap trades. So that's one. The second one we've got is it's a crowded market. It's a crowded market, guys. Everybody is trading currencies. Now, why would that be a reason not to trade currencies? Because there's so much noise around it. It's like, how do I find my edge in something where I'm literally one of many, many, many people getting involved in it? The governments are involved in it, the big banks are getting involved in it, hedge funds are involved in it, all the way down to the small retail guys who are trading with very small size. So how do you carve out an edge? Now, that could be a reason that you quite like currencies, is that you have the opportunity to get involved and play with the big players. However, you've got to make sure you've got a pretty sharp edge to make some money. You've got to make sure your setups are on point. You've got to make sure your strategies are on point. You've got to make sure the disciplines are ironclad. Perhaps where if you're going for something where you're a small cap stock, where you had an edge that others hadn't seen, for example, that you could be one of only a few who are trading that, then your edge might be that you've seen something others haven't, and another large institutions aren't involved in it. So that could be where you make your money, from an edge that you have that others don't have. It's not going to be the case in currencies. You've got to be on the ball. You've got to be very focused. You've got to be very strict about your trading entries. You've got to be patient and wait for exactly the kind of thing that you want. So potentially that's a reason not to get involved in. Number 3, less opportunities. What do I mean by that? I mean that you potentially have a fewer number of trading alerts or setups or strategies that will be triggered. There are a lot of currency pairs. Admittedly, there are a lot. However, there are far more stocks than there are currency pairs. So if you were looking for something, and you were becoming a specialist based on a trading strategy as opposed to an actual market, and there's 2 ways, and go and check out one of the previous videos, talk about becoming a specialist, whether you become a specialist in a market or you become a specialist in a specific setup. If you're becoming a specialist in a setup, you may well find, even though there's a vast amount of currency pairs, there might only be 20 or 30 or so that fit your criteria in terms of spread. Some of the spread on the exotics is quite high, in terms of all those sort of things. So the basket universe of currency pairs is a little bit less than the thousands and thousands of stocks. And okay, even if you trim those down for spread as well, you're still going to be left with a lot more than a basket of just 20. So potentially less opportunities. If you're just going to focus on the currency market and you're looking for a specific strategy, you might find the opportunities are fewer than you would like. Okay, so the other one I've got is there's no open or close. And this is similar to gaps, okay, but what I mean by this is you have to be aware of your risk all the time, 24 hours a day. It's not a case of the market's closed now, I will worry about my position in the morning, I can't do anything about it. I will assess it in the morning, I can just shut off, do something else and refocus. You may well, this actually obviously could be an opportunity for you as well, but let's say the market, you know, in the middle of the night spikes up and then comes back down again. If your stop loss is here, you know, that's going to be triggered. Which wouldn't happen obviously if the market was closed and it was opening back up here. Now, on the flip side, of course, that can present an opportunity, because if your limit is here and you enter in short, then obviously that's going to be good for you. But it might be a reason not to get involved if you think, you know what, I've got to be concerned about the overnight moves, I've got to be concerned about how Asia's trading, I've got to be a little bit more assertive with my position than I would have to be perhaps if I was taking a stock trade and it was closing at the end of the evening. Okay, number 5 is there's many influencing factors, okay? Many influencing factors. What I mean by that, I mean that generally speaking, if you're trading an individual stock, the influencing factor is overall market, then you have the sector, then you have a stock. And the smaller the cap you go down, the smaller the stock, the less influence the broad market has, and the more influence it literally has on the sentiment of the stock, the balance sheet, you know, the income of the stock, how well the company is doing. Pretty much that's it. Currencies, you've got influencing factors from all over the world. It's very difficult to get a grip on, you know, whether this is positive or negative. Even you can read and you can do all your due diligence and all your research and stuff. You've got governments affecting this country, that country, this country, that country. You've got interest rates. You've got lots of variables that can affect the currency. And it's very difficult as kind of retail traders for us to make a judgment based on fundamentals, as opposed to a stock, for example, which could be, listen, it's very, very low price at the moment because they've been struggling. They've come out with earnings now. It looks like they're turning a corner. They're a lot more favorable, a lot more business. They've got a lot more contracts. They've reduced their debt. You can automatically see that it becomes perhaps a much more bullish proposition to take a trade on it. Whereas a currency, it's a little bit harder to do that. So, you know, depending on obviously how you make decisions, if you're pure technical, that won't make any influence at all on you. But, you know, you've got to be careful and say, okay, well, I really have to be on my technical game to trade currencies because there's so much economic data that's influencing it. You know, perhaps you don't have the ability, as well as some of the big guys out there who are doing all this number crunching, all this extrapolating data and doing all these kind of visions of where the country's economy could go. You know, we're probably based on charts and based on doing things like that. So that could be an advantage for you. Of course, if you just want to trade on charts and technicals, that's great. But if you're someone who likes to look at longer term stuff and looks for a value and then get involved in it, then currencies probably aren't the thing for you. So there's 5, guys. If you could think of any more, leave them in the comments below, and I'll see you in the next one. Take care. Bye-bye.